I want to begin by just asking you about the title of your book, which is Living Beyond Our Means, Why Americans Spend While the Rest of the World Saves. And we'll get to the American story in a minute, but I want to know who you mean when you say the rest of the world.
Well, okay, that was for the purpose of the title. We had to come up with something very brief. But really, if you want to be accurate, you'd say the rest of the first world. I mean, we're really talking about the advanced economies of both Europe and East Asia in this respect. And it is quite remarkable that with the exception of a few English-speaking countries like Australia, New Zealand, the UK, Ireland, and of course the United States, that most of the rest of the first world actually has fairly high savings rates, particularly in the core economies of Europe today. I mean, we think of the Chinese as being the great savers, and it used to be that the Japanese were the great savers, and we like to think, well, Americans are normal because we have consumer spending, but Asians, they have this culture, and this culture makes them thrifty. So it's a little odd that they do that, but they have this culture and heritage that makes them do that. The problem with that is that we don't understand that, as I said, the core economies of Europe have very high savings rates. They've managed to retain them over the last 30 or 40 years. So in Germany, France, Belgium, Austria, even in Sweden, we're seeing rates of saving, this is the rate of saving of disposable household income, that are well over 10%. While Americans have been very close to zero, and the latest statistic now for monthly saving in the U.S. is it's dropped down to 3.6%. It's not clear where it's going to go, but we clearly don't save like the rest of the first world.
Well, I want to just pick up on this idea of culture, because I think that Michael Harrington once said Sweden is the way it is because a lot of Swedes live there. And
right.
So a naive view would be that these are, Germans save because they're Germans,
right,
and Japanese save because they're Japanese. And I know that you have a little different view of it, that it's culture, yes, but some other things.
Yes, I mean, what's interesting is that if it's only the Americans who aren't saving and everybody else is, and they have different cultures and heritages, yes, we can talk about culture, but we have to be very sophisticated when we talk about culture. We can't just say the Germans have always been like this, the Japanese have always been like this, because 200 years ago, nobody except for merchants had bank accounts. So there was a process after about 1800 where ordinary people had to learn how to save, and mechanisms had to exist that encouraged them to save. So things like savings banks and postal savings banks and school savings programs, all these things actually had to come in order to make it possible for people to acquire the cultures that we today call German or Japanese or Korean.
So it's,
so it's a learning process.
Yeah, and institutions.
Institutions,
that matter.
yes.
Well, I want to get to the American story now.
Okay.
Because, as you suggested, we are an outlier among first world advanced economies. And you write in your book that by the early part of the 21st century, living beyond one's means was a mark of a good American. I think that's exactly what you
yes.
say in the book. So how did this happen, and when did it happen?
Well, two very good questions. I should say, even before I answer that, I don't know if some of you saw in the money section of the New York Times yesterday, there was a remarkable cover story by a financial advisor who lives in the West, who lost his house and basically over-leveraged himself, became one of these over-indebted people. And the way he explains it is quite interesting, because although he doesn't use the word culture, he's constantly referring to every time I went to the bank officer wanted to give me more money than I wanted to borrow. That when I went back to my neighborhood, I felt bad because I only had a 3,500 square foot house and everybody else had a 5,000 square foot house. And so all of these statements are what scholars would call manifestations of culture. The culture around him what we call the common sense of the community or the nation is dictating that you actually were an idiot if you saved your money when you could borrow. So that's what I mean by culture. But now getting back to your question, when did this American culture form? Well, it formed at various points, and the culture we see today is not necessarily explained by everything that's happened in the past, but clearly from the start of our history, we've had less institutional promotion of what we call small saving, that is, getting ordinary people to save money. We had European-style savings banks, but they didn't spread that much beyond the East Coast and some of the upper Midwest cities. Postal savings was pretty much the norm in the rest of the world, still is. These government-run, you save at your post office. We debated this in the US Congress for 40 years, and finally a tepid version was passed in 1910 that was designed to fail because the commercial banks didn't want the competition. It offered below market interest rates. It was inaccessible. It wasn't in every rural post office. Finally, it died in its sleep in 1966, and none of you can even probably remember that it existed. It was so weak. So we have a long history of not doing as much as Europeans and Japanese to promote small saving in an accessible way. But then the story, it moves in time, and clearly one of the other manifestations is that going back a long time in our 20th century history, Americans have had much more access to credit, both housing credit and consumer credit, than most of the rest of the world has. And in the 1920s, you already had really mass purchasing done by installment plans, automobiles, appliances. In terms of housing, the New Deal created the Federal Housing Administration and the system of government-insured private bank loans that really dropped the interest rate on housing and also gave us the amortized 25 to 30-year mortgage in the post-war period, tax benefits for home mortgages, things like that. So we have this kind of long-term history of a lot of consumer credit, a lot of housing credit mixed with not too much institutional promotion of saving until we get to World War II, when America really does join the rest of the world and has these massive, the U.S. savings bond, the war bond, and the FDIC, which is a 1930s policy that also insures private banks deposits, which also encourages small savers to come to the banks as well as buy U.S. bonds. So the U.S. looks a little bit like everybody else around the period of World War II and right after, but then it diverges again, and it diverges rapidly this time, particularly from about the 1980s. The early 1980s is a kind of a break point. That's when we get the deregulation of the credit card, which means that the credit card industry can function on a nationwide basis, and when people don't pay in full, we call this revolving credit, then they get charged certain interest rates. Those interest rates used to be controlled by state usury laws until about 1980, and those disappear. Credit card companies move to states like South Dakota, where they don't have a usury law, where they can charge anything they want on the interest on unpaid balances. The credit card industry explodes. By the 1990s, it's targeting the so-called subprime market. Subprime does not originate with mortgages, but originates with the credit card industry, targeting lower-income people who will have difficulty paying it back. So we get the credit card expansion. We get the home equity loan, which I talk a lot about in my book, which most Americans don't like to talk about, maybe because it's uncomfortable. But home equity loans, the so-called second mortgage, was something that really didn't exist before the mid-1980s and becomes legitimized by the 1986 tax reform law, which was actually designed to try and discourage people from becoming over-indebted. It removed the tax deductions for credit cards and personal loans, but it left this one loophole of the home equity loan, the second mortgage, as well as the primary mortgage. And at that point, the banks just rushed into the home equity business, and it became what some watchdogs called the homeowners, or the middle and upper middle classes' gigantic credit card, because you had home equity lines of credit, and we still do, that it's very, very easy to get over indebted with these. You know, you write a check against this open line of credit on your equity, you use a credit card or do transfers. It's remarkably easy to get yourself $100,000, $200,000 in debt, as this financial advisor in the New York Times talked about. He had $200,000 in debt in home equity loans.
If I recall, he put no money down for his $500,000 or $600,000 house.
And then we have the mortgages themselves moving, you know, from a down payment system to, you know, in the last, you know, from about the mid-90s to the, you know, these things. Yeah.
But what about, I mean, you know, one of the things you say in your book, and I didn't really realize this, was a lot of this preceded by progressives under the name and the banner of democratization of credit and democratization of home ownership. So in the beginning, some of this was at least portrayed or expected to be positive, that Americans would have more of the good things in life and we'd elevate our standard of living, and what's wrong with that?
And in many cases, there really is nothing wrong with it. And we did get a democratization of credit, really until, I would say, until about the last 20 years, the whole thing was fairly sustainable. Home ownership, you know, explodes in the post-war period. You have the GI Bill, all sorts of things like that supporting. It's not a big problem. People seem to save through their houses. They pay their mortgages. It's also a period of prosperity in America. That makes it a lot easier. Yeah. It's a period of relative income equality from about 1945 to the early 1970s. But so in many ways, the American experiment looked quite sustainable until probably the late 1980s, early 1990s. It was possible to buy things that, you know, people in other places couldn't do because they had to save up for them. And so it did improve the quality of life. And until about the last 20 years, people had no problem repaying their debt. So we could say there was high consumer debt, but people were paying it back. The repayment was very good. What happened in the last 20 years, particularly I'd say from about the mid-1990s, the housing boom, the housing bubble really drove a lot of reckless borrowing because people decided they really didn't have to save anymore, even watch what they borrowed, that the equity in their houses were going up, and they could just keep borrowing from the banks, and the banks loved it. I mean, the banks gave them all these things. Now the banks are stuck with a lot of these home equity loans that can't be paid back. But there's this tremendous expansion that probably goes a lot with the housing bubble.
I wish you'd tell the story of how the Germans handle credit cards compared to the American system.
Yeah, I have various stories of my German and Italian colleagues. You go out to dinner with a German or Italian and you take your credit cards out and you say, what do you call that card? And they look at you like you're an idiot and they say, well, it's a credit card. And I said, well, do you pay it back in full each month? And they said, well, of course we do. And I said, is it tied to your bank account? Well, of course it is. And I said, well, what happened if you didn't pay it back? I'd say, why would I want to do that? And then you say, could you borrow against it? Of course not. The whole point is that if you go to the core economies in continental Europe, not the UK, but the core economies, Germany, France, all these countries, Italy, they have cards that might have Visa or MasterCard or some of the European companies. They are not credit cards. They are what we call delayed debit cards. You do have like a 30-day overdraft that's very carefully given to you. And in the German case, I had this wonderful conversation with a German savings banker in the city of Bremen. He went through the process of how he assigns how much of an overdraft, basically, people are going to get on this delayed debit card. And he said, well, you know, if somebody looks upstanding, they've been a good bank customer, and we know their income, of course, we know their savings habits, okay, we might give them 5,000 euros, and if they're traveling to the US or somewhere, maybe we'll give them an extra 1,000 euros. And if there's somebody we have doubts about, maybe we'll only give them a 500 euro limit. And if we really don't like the person, we're not going to give them anything. And then I said, well, what happens if somebody goes out and charges more than is in their bank account? He said, then we say maybe it's time to give us your card back. So it's, in other words, it's a very personal, Americans would say very paternalistic system. I'm not necessarily recommending that, but it is very different. Yeah. And we have to understand that you will read all these silly articles about globalization. They'll say the globalization of the credit card, and every Chinese, 1.3 billion of them, they all have credit cards, and every German has them, and all that. It's just not true. Most of these are debit cards.
Interesting. And is it, and what, compare the housing. I mean, you say they have, Europeans tend to have smaller houses. More renters.
Right.
Is that part of it as well?
Housing is a big part of this. First of all, in terms of consumption, both European, East Asian houses, we have charts of what the average size of new homes are in all these places. It's really remarkable data. And most not surprisingly, or maybe is surprising to Americans, Americans have houses of a magnitude that are like no other. That the average size of an American house at the 1950, when the GIs came back, was a little over 900 square feet. It was really small. Okay, this today is, most of the first world lives in houses that are about 1,000 to about 1,200 square feet. Italians are about like 850 square feet. I mean, they're really small. Today, the size of an new American house averages about 2,400 square feet. And in fact, right before the 2008 crash, it had gone, I think, up to almost 2,500 square feet. So this is an enormous increase. Now, what does it mean? Well, I mean, if we think about it, it's not surprising that Europeans or Japanese would not spend so much and would save more because there's only so much stuff you can put in a small house. Whereas we have these huge houses that have to be filled with stuff, with sheer volume, that have to be heated, that have to be cooled. We build them way out in suburbs with no public transportation, so you got to have a couple of automobiles, and that costs more and more gas. So everything about our housing is oriented toward getting us to consume more and to save less.
And you have to renovate your house after about, especially the kitchen after about 10 years.
Yeah.
But you're talking to New Yorkers here who have a more sensible...
Who live more like yes, right.
So we can laugh at the suburbanites as much as we want. Well, I don't want to lose an important part of your book. We've been talking about the contemporary debacle, but we do have a tradition of thrift in America. Mm-hmm. Of course, Europeans love Benjamin Franklin almost more than we do. We venerate him as a sort of a scientist and philosopher king and a diplomat, but in Europe, I gather, he's renowned for his thrift and his thrift saving. So we have Franklin sort of setting the table in America. And then in the 19th century, we begin to build a few thrift institutions. So can you talk about our tradition of thrift?
Yeah, I mean, I guess just even using words like our tradition of thrift makes me a little bit uncomfortable because I don't know if, well, it may be incendiary here, but thrift is not necessarily an American value, but it has been a value in America. And that's different. So the values of thrift that we have had here are actually quite similar to what we've seen in Europe and Japan. And of course, they had actual European influences. So things like savings banks, postal savings, the whole idea of getting school children to save, to inculcate values of thrift in them. These were not indigenously American, but they were the result of these transatlantic communication, which was very strong in the late 18th and 19th century. So what we see in America is not so unusual. The problem is a lot of it in America has been more uneven than it has been in a lot of the European countries and Japan, in part because we have a much more decentralized system. So that in some states, the state of New York had an elaborate system of savings banks where they used the English savings bank law of 1817 to basically manage a very elaborate system, very well-regulated system. Massachusetts had something different, something similar, I should say. So if you went state by state, there are some states that seem to be very much part of this transatlantic community of thrift. And then you go to lots of other states, and you might have had individually thrifty people, but there was no institutional infrastructure for them to save in. And as late as 1910, as I show in my book, if you went to most of the southern states and western states, and this is a big chunk of the American population, most people did not have access to a savings institution. So they could have a nice value of thrift, but if you don't have a place to actually put your money, it's difficult. And if you don't have a school that's promoting it, it's difficult.
Well, is it our federal system that's partly to blame, or is it regional differences, or is it Anglo-American culture, if you will? Why?
No.
Why?
Well, I mean, New England was Anglo-American culture, very, very strong network of savings banks. Federal system, well, the way our federal system works, probably, but of course, Germany is a federal system where states have a lot of autonomy, and yet they have, you know, a very dense network of savings banks and other savings institutions. Part of it is, I think, commercial banking arose in the United States at a much earlier a phase than it did in most other places. I mean, the first part of the 19th century, commercial banks were very weak in places like France and Japan, which really became a modern nation after 1868. 1870s, postal savings was founded at a time when there was scarcely a commercial bank. So the commercial banks have, and if there are bankers here, I apologize, but the commercial banks have traditionally in this country been very hostile to the creation of special savings institutions for small savers. They've tended to be quite unfriendly to the small saver. That got a lot better in what I call the golden age of saving in the US, which is remarkably recent. When FDIC comes in the 1930s, and especially the 1940s and 50s, commercial banks became a friendly place for savers. And of course, you had savings and loan associations
And credit unions.
Credit unions, although they have always been a small part of the story in America.
But a noble part of the story.
A noble part, but a small part, and they have not captured, you know, much of this.
They've persisted.
Yes, they have.
They've persisted over time.
Right.
So.
But they have not done what the savings banks have done in other countries.
Can you talk a little bit about thrift campaigns and savings campaigns? Because I know that when we first met you, you did this wonderful presentation where you showed us posters from Japan that were part of savings campaigns.
Right.
And so this combination of, you know, sort of governmental promotion and moral suasion and patriotism. What can you talk about thrift campaigns as a sort of genre, and then what makes them work? Why are they successful? Because they have been.
They have been, and they are a very transnational phenomenon. So, I mean, in this country, the savings campaigns have largely been associated with war, with the two world wars. So in World War I, the United States consciously adopts the British system of what was called national savings or war savings campaigns, which is to have a very elaborate network that went all the way down to local level. And in World War II, again, now we have the savings bond, which was a very effective instrument, and you could use it in the schools and in neighborhood organizations and things like that. So we have had very elaborate campaigns. In our country, they've largely been associated with war. In other countries, they've been associated not only with war, but often post-war reconstruction. So the idea of the savings campaign, you know, probably starts with the French and the Franco-Prussian War in 1870-71. The Japanese and the Russo-Japanese War had elaborate campaigns, and then mainly World War I. But what you see in both the European and Japanese cases is these savings campaigns continue beyond World War II. So the war ends in 1945, but these very intensive, intrusive savings campaigns do not end in both the European nations and Japan, because both of these cases have experienced things that the Americans have not. Intensive war damage. Many of them have lost the war, like the Germans and the Japanese, and there's a very important period of reconstruction which demands finance. and you can get it by taxes, but the easiest way is to get it from the savings of your people. So you have these very elaborate post-World War II national savings campaigns, British, Japanese, they're called, in Britain the term was keep on saving, in Japan it was called national salvation campaigns, and they were very important in, very important in Japan and in Europe, both Western Europe and in communist Eastern Europe. So the communists used these campaigns too. So while everybody in the world in the late 40s and 50s are doing these austerity campaigns and restraint of consumption campaigns, of course the United States, which doesn't have damage, which is, controls a huge percentage of world production, very, very prosperous. Of course, we stopped that sort of overt campaign, and for good reason. We didn't really need it anymore. I mean, there were minor U.S. savings bond campaigns in the schools, but basically, we haven't seen those campaigns very recently, whereas Europeans and Japanese have.
Yeah. Well, one thing I thought was really interesting in the book was that there's a balance shift in the U.S. in the post-war period where savings policies sort of weaken, though they persist, and people still are saving. But there's this bipartisan governmental consensus for consumption, that prosperity could be fed by the American consumer. And there were all kinds of appeals as well as, so you could almost say, or correct me if I'm wrong, that we shifted from savings campaigns to consumption campaigns in the United States in that golden era when we could probably afford to consume more.
Yeah, we actually did both. We both saved and consumed in the period of the 1950s and 60s. But you're absolutely right. In the book, I explain this in terms of American Keynesianism, that there is Keynesianism and there is American Keynesianism. Keynes in the 1930s, people often sort of wrongly see him as just sort of an anti-saving guy, and that's too simple a reading. But he said if you're really in a downturn and you want to stimulate the economy, well, first of all, you want government spending because you're trying to stimulate job production, things like that, and then you want people to spend. You want to get consumption in the economy to confront the downturn. So Keynes is very counter-cyclical, and most people don't know this, but in my book I talk about it. In World War II, when he's working for the British government and the economy is overheating because of wartime production, Keynes calls for compulsory savings. He actually is more radical than most, but he's really he wants people to restrain their consumption and to save in order to curb inflationary pressures. So Keynes, the man in British Keynesianism, is basically counter-cyclical. But during World War II, a group of New Dealers embraced a more optimistic type of Keynesianism, where they said it doesn't matter whether you're in a downturn or an upturn, people should be spending at a high level, and this will ensure continuous economic growth. And it is one of those things that differentiates us as Americans from others, because the Germans, for example, have never really accepted this idea, this sort of constant promotion of consumption, and a lot of other people have not as well. So this became really a bipartisan consensus in the early post-war period, embraced by Democrats and Republicans, embraced by employers and labor unions, and that the labor union was interesting because in Europe and Japan, social democrats and trade unionists tend to be skeptical of the promotion of consumption. They think it'll lead to more class differences, to less investment in production and job creation in their economies. But the American labor movement very much in the late 40s and 50s embraced this idea of the increase of purchasing power, is what they called it, was the most important thing, and that government should stimulate this, through the promotion of housing, through the promotion of consumption. So I agree with you, and we haven't left that. And so in one of my more whimsical moments, I decided to do the history of the Christmas shopping message. At what point were Americans told that you have to go shopping at Christmas time because the life of our economy depends on it? And it starts about 20 years ago. President George Bush I, in I think 1989 or 90 maybe, actually had television cameras, and he went to a J.C. Penney to show that he was shopping. And this is, this has become the gospel in America.
Yeah.
Which makes saving kind of a dirty word.
Yeah, no, exactly. Well, we hear all the time, 70% of our economy depends on the American consumer, and the American consumer actually is quite a reified figure. I mean, you say, I'm an American consumer, I should go out and spend, and you sort of think, where did that all begin? And it probably did begin, if I'm right, if you're right, in that post-war period where consumption, expanding consumption was linked to the democratization of prosperity for everybody. And it wasn't sustainable, I gather.
Well, and so the question is, when does it cease to be sustainable? And again, I think that's a recent story. It's a post-1980 story, maybe post-1985, because it was sustainable before. But what makes it unsustainable? And one thing we have to come back to is growing income inequality in this country, particularly in the last 10 years, but probably going back, a trend that starts in the 1970s. As I said, in the early post-war decades, we had a remarkably, it wasn't totally equal, but a remarkably equal, relatively equal levels of income. Or at least that the lower quintiles were advancing fast and sometimes faster than the higher quintiles of income. So that stops, and of course, since about 2000 or 2001, I think if you look at income, real income, that I think for about 80 or 90% of Americans, they've actually fallen behind, and for some way behind. And yet that was precisely the period, this period from the mid-1990s to the 2008 crash, when Americans took out more and more credit as their wages were actually stagnating. And one of the tragic elements here is that the expansion of credit basically became the American welfare policy, the way of dealing with social problems. So that in Europe, when people got in trouble, they got social benefits. In America, when people get in trouble, we extend them more credit. And that's been a huge part of this story. So not only people stagnating their incomes, they're not getting much in terms of social benefit, and they're getting further and further into debt.
I'm wondering how this all affects young people, because we
have some here.
Yeah, we have some here, and we have some at home. You do, and I have some.
Well, they're here.
Okay. Good. But this is a concern, not only because of school debt, but because young people today sort of grew up in the midst of this consumer credit boom. So, they're accustomed to credit cards and buying on credit. And will this recession imprint them in a way that the Depression imprinted people who were young and said, never again? Or talk about the future for younger Americans.
Oh, that's going to be hard, because it's sad. I mean, there are two things at work here. It'd be easy to focus on young people's reckless addiction to credit. I mean, that has happened. I mean, the credit card industry, and I don't want to single out the young here. I want to single out the industry. Credit card industry was absolutely predatory when it came to young people, and they decided that one of the easiest audiences, one of the easiest targets, was young people, because if they got seriously into credit card debt, probably their parents would pay it back. So in a sense, they were better than lower income people, better risks in that sense. So what did credit card companies do? Well, if any of you have been to a university in the last 15 or 20 years, when you go for your orientation, one of the first things you see are the Visa and MasterCard people set up tables. And why do they set up tables? Because our universities get kickbacks from them to do it. It's really insidious. And one finds that there was a survey at Princeton, yeah. And I think they still may be doing it. And maybe I'll use the book as an opportunity to see if I can, except they hate it when people make noise at Princeton. But, yeah. Anyway. But so that got people very addicted, and of course, those of us who are older, we're struck by any time you go into a Starbucks, no young person has cash anymore. Now, okay, if they have debit cards, that's fine, but to use a credit card to get a $3.50 cup of coffee, that amazes people in my generation. But right, so that clearly they hooked young people on credit. And so you can say, well, okay, the industry was bad and young people were bad for getting hooked on credit. But then there's even a more serious problem, and that's a student loan problem. And there's nothing frivolous about that. Because education costs more and more in this country. I mean, if you ask me, people have really decided they're not going to pay higher taxes anymore, so the public education system's in a lot of trouble at the higher education levels. Costs are going up and up. And young people are taking out more and more loans. The federal government loan program at a certain point wasn't really providing much, it had a lower coverage than it did before. Private sector got into it. I think a lot of those loans were fairly predatory. But for whatever reason, many young people have taken out loans in the tens of thousands of dollars, and the prospects for them getting a high-paying job to pay it back are remote at this point. Maybe in 10 years it'll be better, but maybe not. And this is a very sad story, and one that the student loan story has to be told alongside the credit card story for young people.
Yeah, it's a big problem. Now, I want to, be a little bit of a devil's advocate, or at least ask you to respond to some criticisms that one hears about saving. And the first one, of course, is the paradox of thrift. Mm-hmm. The Keynesian doctrine that in a down economy, it's good for individuals to save, but not good for the economic recovery. Is Keynes wrong about that?
Well, I think the way that Keynes has been used is very misleading. Paradox of thrift is a term that I think journalists love because it has a certain elegance. I'm not sure that many economists pursue it quite as much. But the paradox of thrift for all of you is well, Barbara just stated it, but that thrift may be good for you, but it's bad for the economy. Well, there are some things that are wrong with that formulation. If it's used to discourage saving, and if it's used to get people more and more indebted, there are problems. One problem is that Keynes in the 1930s didn't seriously think that the revival of an economy was based on individual consumer choice. He had a frivolous interview about housewives, but that was small stuff.
Right. Speech.
What's that?
It was a speech.
It was a speech. He was having fun. But basically, Keynes thought that in a recession, a serious recession like the Great Depression, that people weren't going to suddenly open their wallets because they couldn't. So he really recommended government spending. It was only government that could step into the breach at that point and spend heavily in ways that then eventually would promote consumer spending as people had jobs and people didn't worry as much. So we have to keep in mind that, when I hear these debates today, well, I'm sure we have political differences over this, but it is not up to the poorest consumers in America to get this economy going again. They can't do it. And that leads me to the second point, which is I think people need to think about what they're saying when they say that the economy simply needs consumer spending and they send that message. Yes, for people who are more affluent, it's great for people to open up their wallets and get the economy going. But I would estimate that probably about 50% of American households now are seriously in trouble. Either job loss.
50%?
I would say the median income, which now has fallen to about $48,000 or $49,000, which is not very high, considering that people have to cope with health emergencies, things like that, and that a large number of Americans are homeowners. And that's their chief source of wealth. Most Americans are not seriously into the stock market, the home market, however they are. And in these places where home prices have fallen 30%, if they have borrowed heavily against it, they are in a lot of trouble. And it's not just underwater because of their primary mortgage, it's their secondary mortgage. So for all of these people, it strikes me as almost criminal to try and encourage them to spend at a time when their lives need to be stabilized. They need to be They need to be working down their debt and accumulating some margin, saving that so they can cope with life's emergencies. So I don't think it's the responsibility of our poorest consumers to get the economy going. I think that's where government has to step in, and that is politically contentious today.
Well, speaking of government, there is this argument that government entitlement programs, beginning with the New Deal, have sapped the incentives for private savings. And so, you know, maybe if we weakened the safety net or took away some of the entitlements, people might be incentivized to save more, you know, of their private savings, and taxpayers would be relieved of that burden.
Sounds like a post-apocalyptic vision. Okay, here's what's wrong with that. There is a very famous thesis in American economics departments that goes back to prominent economist Martin Feldstein, who was President Reagan's chairman of economic advisors. And it was a thesis in the 1970s that said exactly what you said, that our Social Security was eroding the incentives to save. And it was modeled that, you know, that each, well, like economists do, you know, each dollar that they got from Social Security led to less and less saving. Well, I did meet Professor Feldstein a month ago, and he told me about his thesis again, was very proud of it. And he said, the funny thing is that, he said, I went off to France soon after coming up with this model, and the French economist said, well, that's a little strange, Professor Feldstein, because we French have an elaborate national pension system like your Social Security system, but we save a lot. And then it turns out, when you look at the statistics, that almost all of the great European welfare states have very high savings rates. Whereas the United States, which, with the exception of the Medicare, Social Security for the elderly, we have rather weak safety nets. If people were being rational because we have weak safety nets, they would actually be saving more. Americans actually saved very little given our insecurities, whereas the Europeans who had these elaborate welfare states saved more. How do we explain that? Well, here's my explanation, that when we let so many people in this country fall off the cliff and devolve into poverty and destitution, they're not going to save. Whereas the core European welfare states keep most of the population in a middle-class status, out of poverty, and they're going to save more because they're stable. Stable households save.
Okay. All right, I have another one for you.
Okay.
What's the point of saving when the interest rate today is near zero? Isn't that one of the biggest disincentives for an ordinary small saver to begin to save? Why not put it under his mattress or her mattress?
Because somebody's going to take it and borrow it from you. There historically seems to be very little correlation between interest rates and people's propensity to save. It sounds strange, but it's not so strange if you're actually an American living right now, because if you are worried about the future right now, which as an American you probably should be, people seem to actually be saving more even though they're getting zero interest from the bank. Japanese did this in the 1990s. They put all their money into 0% accounts and postal savings, and we all laughed at them. And now we're doing that. Why do people do that? Because in a time of insecurity, while you would love to have a higher interest rate, you're seeing your money slip away in every other way. You're seeing the housing market, it's gone down, the stock market's very volatile. You lose it obviously by spending more. And so people decide, they're not happy about it, but they make the decision, I'd rather have the principal left than to deplete it. I'd rather have it in a safe place, guaranteed by FDIC. So we're doing that now. So I don't think it'd be great to have higher interest rates, but they don't seem to be discouraging people from saving more now.
Mm-hmm. Now finally, because you're a scholar of Japan, you're the best person to ask. Japan is a model of savings. You say so yourself, and yet very often this is the cautionary tale for all of us, that the Japanese saved and saved and saved, and they got mired in a terrible, they just couldn't get prosperous again, really.
Right.
So what happened to Japan, the nation of great savers?
Yeah, I mean, that's a very good question. And when I first imagined this project, the Japanese were the world's greatest savers. So it is interesting. History moves. I mean, what happened was there was a bubble in Japan. It's a little different than our bubble, but it was a real estate bubble and a stock market bubble. And it was burst around 1990-91. At that point, the Japanese economy went into what we're still in now, almost 20 years of stagnation. There were some good years, but basically the rest were either stagnant, sometimes negative growth. It's probably true that if the Japanese had consumed more at a certain point, that they might have jump-started their economy, but they didn't. And what's happened today is that household incomes in Japan have really declined over the past 20 years. People have, until recently, pretty much kept up their consumption. They haven't expanded it, but they've kept it up. But as their incomes have declined, they've had less and less to save. And it's not that the culture of saving has vanished in Japan. You still have all these housewives with these elaborate household account books and things like that, but there is less and less to save. It may be cautionary in a certain way, but it seems to be a variant from the European pattern. It's not what's happening in Germany or Belgium or Austria or Sweden, where somehow they've had moderate levels of consumption, but also very high levels of saving.
Now, I don't expect, I mean, I don't know that we can just imitate the European nations that have been successful, but what's your prescription for America, given all the sort of outlier tendencies that we currently have? What kind of savings policies or programs or children's savings plans do you envision as a
I mean, the book actually does end with something a little unusual for a historian, policy prescriptions, which I learned from my year in Washington. And they said,
they got to you.
but they were right. And it was actually very useful to think about that, because the historical record, both of what we have done in the past well and what other nations have done and continue to do, is actually a very important thing. Americans don't like to look abroad for models, but there are things we can do without becoming German or Japanese. And I'd probably group them into three areas. One of them is we have to carry out policies of financial inclusion. We have a huge percentage of the population, particularly lower income people, who are unbanked. They are unbanked not because they're lazy or slothful or anything like that, because the banks are really unfriendly to them. And we just saw that with the Bank of America and other banks trying to gouge their poorest customers to respond to, you know, a loss of somewhat obscene profits. So we have a tradition of being very unfriendly to lower income people and to small savers in general. So there are ways of doing that, but basically, I mean, there are lots of variations. I think government has to work with the banks to come up with small savers accounts, to come up with youth accounts, perhaps tax advantages for banks to do this, but some way or another, the banks have to be incentivized to do this. And if they don't do it, and they won't want to do it, then I have a really radical, somewhat, it sounds like a lunatic prescription, just happens to be normal everywhere else in the world, and that is bring back postal savings, at least for small savers accounts. We have a post office that's about to disappear.
That's the problem.
No, that's the solution. Because what other countries in Europe and Japan have found is that as postal delivery goes down, they've actually made up the difference through postal financial services. And it's actually rescued places like the Japanese postal savings, French postal savings system. And we could do that. And we have to stop thinking that these things are nuts when they're normal elsewhere. So this could be very possible. And it's, you know, maybe it's a bad reference. It's sort of the public option type thing that in 1910, when postal savings actually came in, it actually pressured the commercial banks to be friendlier to small savers, to compete with them. And I think our commercial banks need a little competition from from a postal savings system. So that's a possibility. Now, if banks want to do this themselves, okay, I'll take away the threat of postal savings. But I think they need that.
We have bank transfer as sort of a version of consumers saying, come on, if you're going to load us up with fees, we're going to go elsewhere.
Right, there is that, yeah. And part of this financial inclusion, I think, involves a lot of push for youth savings. And I think we need a nationwide school financial education program. It's very haphazard now. A few places do it well. It's very poorly coordinated. The new Consumer Financial Protection Bureau seems to have some mandate to get into that. I don't know how strong it is, and I don't know what they've done. But we clearly, at the very least, we don't just have to tell our children to save. We have to educate them about the whole financial world, about saving, investment, credit, housing. They've got to go into the real world with more knowledge than we're giving them. So that's financial inclusion.
Well, I want to go back to posters,
okay,
because I'm interested in the moral suasion side of efforts to get people to save. And I can't really think of a successful savings program, even including institutions, that doesn't have some ethical kind of content to it that it's good. There's a positive value to saving. And what strikes me about policy prescriptions is all too often they're devoid of that. And they expect, they're kind of rational, they don't get to people's sort of inner motivations successfully. So I'm wondering if, I know some people get a little nervous if you say moral, but an ethical rationale for savings is a good thing to do, even beyond accumulating money for yourself. Does that make sense?
Well, again, it makes sense everywhere else in the first world. But yes, I mean, and it should be an element in financial education. And I've studied, for example, what the Bank of Japan does in Japan. And a lot of their financial education is hooked into imparting to students, as you say, maybe they wouldn't use the word moral, they would probably use the word the social value of saving. They tie it into environmentalism and about not wasting resources. And I think that this would be a very important angle. You also see this in Europe, as sort of a tie between environmentalism and the
here
promotion
too,
of saving.
to some degree.
Yeah. So, I mean, I would do that. I don't know that you can use sort of 19th century type words in terms of the moral promotion of saving, but I think you have to tie it into the good of society and the good of the earth. And I think that's very important.
I think on that note, we're ready to take questions from people in the audience.